If you are building a high-growth startup in Singapore and you need real capital to scale but the idea of giving away control keeps you up at night, there is a government scheme that deserves a place on your radar. It is called Startup SG Equity, and the idea behind it is unusual. Instead of writing you a grant or handing you a loan, the government actually invests in your company alongside private investors, taking a stake and sharing the risk with the people already willing to back you. In the next few minutes, we will unpack what Startup SG Equity really is, what co-investment actually means, the difference between the general and deep tech tracks and why deep tech is treated differently, who the scheme is genuinely for, why you have to attract a qualified private investor before the government will follow, and where to check the live terms. One important note before we begin. This channel is educational only. We are not a government agency, we are not affiliated with or endorsed by Enterprise Singapore or Assets Capital, and nothing here is official advice. The investment ratios, caps, qualifying criteria, and the definition of an eligible investor are all set by the authorities and reviewed over time. So treat everything in this video as background, and always confirm the current details on the official source, startupsg.gov.sg, before you rely on any of it. What Startup SG Equity is? Let us define it plainly. Startup SG Equity is a co-investment scheme. It is the mechanism through which the government, working through Enterprise Singapore and its investment arm Seeds Capital, puts money into promising local startups by taking an equity stake, but never on its own. The government invests alongside independent private investors who have already decided your company is worth backing. In other words, this is not free money and it is not a subsidy. It is the state becoming a shareholder in your business, on commercial terms, next to your other investors. The goal is to help innovative, high-growth Singapore startups raise larger rounds by having the government share a risk private capital alone might find too big to take on early. If your company succeeds, the government stake grows in value like any investors. If it does not, the government carries a share of that loss too. That shared risk and shared upside is the whole point of an equity scheme rather than a grant. Who it's really for. So who is Startup SG Equity actually for? This is where a lot of owners get the wrong idea. So let us be honest about it. This is not a scheme for every small business in Singapore. If you run a steady, profitable local business, a cafe, a trading company, a services firm, this is almost certainly not your route. And that is fine because there are other schemes built for you. Startup SG Equity is aimed squarely at innovative, technology-driven startups with genuine ambitions to scale beyond Singapore, and the kind of high-growth potential that makes venture investors interested in the first place. The scheme is designed for founders raising equity rounds, comfortable giving away a slice of ownership for capital, and needing a larger pool of investment than private investors alone will commit. If that does not sound like your business, there is no shame in it, and knowing a scheme is not for you saves you chasing something that was never designed for your situations. How co-investment works. Now the part everyone wants to understand, how the co-investment actually works. The core idea is simple. Even though the details are set officially and change, the government does not lead your round or pick winners on its own. Instead, once a qualified independent investor commits to your startup, the government can come in alongside them, usually on the same terms as that private investor. So the private investor and the government both buy shares in your company, at the same valuation, on broadly the same conditions. What matters for you as a founder is the principle. Private capital leads, government capital follows, and the two going together, side by side as genuine shareholders. The exact ratios, the investment caps, and the point at which the balance shifts are all set by the authorities and have been adjusted over the life of the scheme, so I am deliberately not going to quote you fixed figures here. The live numbers always come from the official source, the general and deep tech tracks. Here is a distinction worth understanding, because it shapes the scheme. Startup SG Equity broadly runs along two tracks. There is a general technology track for the wider pool of high-growth startups and the deep tech track for companies working on more scientific and engineering-heavy innovation. Deep tech means the hard stuff. Think advanced manufacturing, biotech and medtech, clean energy, or agri-food technology, the kind of work that can take many years and a great deal of capital before it reaches the market. Because deep tech is riskier, slower to commercialize, and more expensive to build, private investors are often more hesitant to fund it on their own. So the scheme generally allows a higher level of government co-investment for deep tech startups than for general ones, and it can stay invested up to a larger cap. The logic is straightforward. Where the market is least willing to take the risk, the government leans in a little further, so genuinely ambitious science-based companies are not starved of the patient capital they need. Which track your company falls under, and the specific caps are defined officially, so that is something to confirm rather than assume. You need an investor first. There is one condition at the heart of this scheme that catches many founders off guard, so let us be clear about it. The government will not invest in your startup just because you asked. You have to attract a qualified independent third-party investor first. The whole design leans on the judgment of the private market. The government is essentially saying, if a credible independent investor, risking their own money, has looked at your company and decided to back it, then it is willing to come in alongside them and amplify that commitment. That means your first job is not to court the government, but to build a company compelling enough that a real investor wants in. And not just any investor. The scheme generally requires that investor to meet certain qualifying conditions, so the private lead is genuine and independent, not a friend or related party arranged to unlock government money. This ordering matters enormously. Founders who understand it spend their energy getting investment ready and winning over private backers, knowing the government portion follows. Founders who miss it waste months waiting for a government check that was never going to come first. A work example. Let us make this concrete with a made-up illustration, because the idea of a ratio can feel abstract. Imagine a small Singapore-based startup building new software with strong growth potential. The founders pitch, and an independent venture fund that meets the qualifying conditions decides the company is worth backing and commits to invest. Because that private investor has led, the startup may then be eligible for the government to co-invest alongside them, up to a cap share of the round on the same terms. So the round is filled partly by the private fund and partly by the government, and the founders raise more than the private investor alone might have provided. Now imagine a second company working on a deep tech breakthrough in medical devices, which will take years of research. Private investors are more cautious, but one qualified investor commits. Because this is deep tech, the scheme may allow the government to co-invest at a higher level, helping close a round that would otherwise be very hard to fill. Notice the pattern. A private investor leads, the government follows and amplifies, and the founders end up with the capital to push forward. The specifics of eligibility and how much can be co-invested are always governed by the official rules. Some common misconceptions. A handful of misconceptions trip founders up again and again, so let us name them. The first is thinking Startup SG equity is a grant or free money. It is not. The government is buying equity, becoming a shareholder, and expecting a return like any investor. The second is believing you can get the government to invest without a private investor. You cannot. The independent private lead comes first, always. The third is assuming every startup qualifies. The scheme is aimed at innovative, high-growth, technology-driven companies, not steady local businesses, and the criteria are specific. The fourth is confusing the general and deep tech tracks, and assuming your company gets the higher deep tech co-investment when it may sit under the general track instead. The fifth is arranging a friend or related party to pose as your investor to unlock the government portion, which runs straight into the qualifying conditions on who counts as an independent investor. And the sixth, the one this channel keeps repeating, is relying on second-hand figures from an article or a video instead of the official source, when the ratios and caps genuinely change. How to check? So how do you actually make sure you are on the right track? Start on the official channel rather than a forum or an old blog post, because that is the only place the current ratios, caps, and criteria live. In practice, Enterprise Singapore administers Startup SG Equity, with Seeds Capital as the investment arm, and the Startup SG website explains the scheme in full. The sensible sequence looks like this. First, be honest about whether your company is genuinely the innovative, high-growth kind of startup the scheme is built for. Second, focus your energy on becoming investment ready and attracting a qualified independent investor, because that private lead is the key that unlocks everything else. Third, read the official Startup SG equity pages so you understand the current tracks, the co-investment ratios, and the caps as they stand today. Fourth, understand which track your company is likely to fall under, and confirm it rather than assume. I want to be clear about one thing. We cannot invest in you, approve you, or guarantee any co-investment, and no one honestly can. What you can do is build a fundable company, win a genuine private investor, and read the official pages, which is entirely in your hands. A quick recap. Let us pull it together. Startup SG Equity is a government co-investment scheme run through Enterprise Singapore and Seeds Capital, that lets the government take an equity stake in promising Singapore startups by investing alongside qualified private investors. It is not a grant and not free money. It is the state becoming a shareholder on commercial terms. It runs along two tracks, general technology and deep tech, with deep tech generally allowed a higher level of co-investment because it is riskier and more capital hungry. It is aimed at innovative, high-growth startups, not every small business, and it only follows once a genuine independent private investor has led. And because the exact ratios, caps, and criteria are set officially and are reviewed over time, the live details always come from startupsg.gov.sg, never from memory. A closing reminder, remember the spirit of this channel. Our job is to hand you the map and the vocabulary so schemes like Startup SG Equity stop feeling like alphabet soup, and you can walk into the official pages already knowing what you are looking at. But the official sources always have the final word. Nothing here is a promise that you qualify, that the government will invest, or that any figure you heard is current, because the ratios, the caps, and the criteria genuinely do change. When you are ready, focus on building a company worth backing. Win over a qualified private investor, and read the official Startup SG Equity pages on the Startup SG website, and plan from there. If this made Startup SG Equity clearer, subscribe for more plain English Singapore grant explainers, and we will keep turning these schemes into plain English, one scheme at a time, so you can stop leaving support on the table.